What is up, everybody? UNH, the big boy in this sector, the biggest player in health insurance, just reported their second quarter earnings. We knew the quarter wasn't going to look pretty, huge increases in costs. They're citing all the same things that Elevance and Centene and all these other health insurance companies talked about on their second quarter earnings. They massively mispriced their plans. They almost certainly have a couple more bad quarters ahead too, until they're able to get rates and prices more in line for 2026 and 2027. So the most important thing on this earnings was really hearing what is management saying about the future. What are they saying about next year and the following year? Where are margins going to end up? We'll dive into all that. We'll look at the numbers. If you get value out of this video, subscribe to the channel. If you want to buy me a coffee, I have a link for that in the description. Absolutely no need to give anything. Watching the videos is honestly the best thanks, but I'm very grateful for any support. Now, to just give you an overview of UNH, you can see on the left how their insurance book breaks down among all these different segments. The purple and the fuchsia, shall we call it, is their commercial group. These are those employer-sponsored plans. This segment has been a bit less exposed to the pressure and headwind that we're seeing elsewhere in health insurance. The orangey yellow at the top is Medicare, and this is where they've had a ton of headaches. This is where they're facing the biggest collapse in margins. They really missed the boat on the price trend here. They're not alone. This is affecting other companies too, but this is a significant segment for them, and they have the additional headache of being under the scrutiny of the DOJ. You're probably aware now that there is a DOJ lawsuit, a DOJ investigation into UNH, and that is based mostly around their coding practices for Medicaid. The DOJ is alleging basically that UNH artificially inflated the risk scores of these Medicare Advantage patients. Doctors put in codes, and those keep track of patient conditions, and the DOJ is saying that you upcoded. You basically made your patients look sicker than they actually were. And the reason they would do this is these risk scores are used to determine reimbursement rates back to UNH. So basically, you make your patients look sicker, you can get more money coming back to you. Of course, UNH has denied this, and they even said back in May that, we don't even think there's an investigation going on. A criminal investigation into us? I don't think so. Now, just a week ago, UNH has changed their tune. They said, yeah, there was an investigation going on. We just didn't know about it. The DOJ didn't tell us. And in fact, we're going to start our own self-review of all these practices. We want to get this off of our plate. So it's pretty much been one rough piece of news for UNH after the other. Their CEO, Andrew Whitty, also stepped down back in May. And they brought this guy, Stephen Hemsley, back in. He's the chairman of UNH and also was CEO for 11 years, I think from 2006 to 2017. And if there's anyone you want to bring back in to run your company, it's this guy. He oversaw an incredible period of growth for the company. He understands the business obviously incredibly well, but he is also the largest individual shareholder of UNH. He has an enormous amount of his net worth here. He's definitely aligned with us shareholders. When he came on as CEO, he's only taking a $1 million salary, which may sound like a ton of money, but let me tell you, for a CEO of a major company like this, that's actually extremely small. Most of his compensation, about $60 million worth, is in the form of stock options that do not vest until 2028. So I imagine he's incredibly motivated to see UNH turn it around. And in fact, he was buying even more shares on the open market after the price collapsed. You see tons of executive selling up in the 500-600s, which is pretty typical. They get options. They want to sell those options. They don't want to be fully invested in the company that employs them. But now after the price collapse, insiders, they aren't really selling their shares anymore. I mean, there's only been one sale by this guy, Patrick Conway, for only 589 shares. And here you have Stephen Hemsley buying over 86,000 shares on the open market at $288. This is like a $25 million purchase that he made with his own money. And it's not just him. You have 5 other insiders who are buying shares down here. This is a huge green flag for me. Now, with all that said, let's jump into their quarterly earnings because it wasn't pretty here. The big headline is going to be this: full year 2025 earnings outlook of at least $14.65 per share, adjusted earnings of at least $16 per share. Keep in mind, coming into this year, people were thinking adjusted EPS was going to be high 20s, maybe 27, and then they adjusted that to low 20s. Back in May, they completely cut their guidance entirely. They said, we don't know what we're going to earn, but it's not going to be low 20s. Coming into this report, I was thinking adjusted EPS for the year was going to be about $18 to $19 a share. So this is definitely a miss. Top line outlook is fine. In fact, this is going to be a record year for them revenue-wise. This $445 billion, this represents, roughly a 10% increase over the past year. We see their numbers here. You look at the revenue. I mean, the revenue looks perfect. They were just over $400 billion last year in 2024. Now they're going to be 440 to 450 million. Top line is not the problem. The problem is the bottom line. The problem is the margins. And this wasn't a margin hit to any one segment of their business. I mean, some were hit more than others, but this was pretty much across the board. Margins are down. Medicaid rates are down. Marketplace, they mispriced their book. Medicare, this was probably the biggest miss. I mean, when we're just talking about United Healthcare, keep in mind that UNH, they have basically two big segments. They have their insurance segment, United Healthcare, and then they have their services, their PBM-sided segment. That's called Optum. We'll get to Optum in a moment. This was not a good quarter for them either, but the biggest problems really are in health benefits, this health insurance side. And if I were to focus the issue somewhere, it would definitely be on Medicare. These Medicare plans they have now, these 2025 Medicare plans, they start preparing those in the beginning of 2024. They can't just turn around and reprice them all of a sudden. It takes time. And when they bid for these plans, they were assuming a cost trend of 5%. Basically, they were assuming that costs were going to go up by 5%, but the actual numbers are coming in more like 7.5%. And let me tell you, that is a massive miss, like roughly a $3 billion headwind on operating earnings miss. ACA and commercial, they're seeing greater utilization rates, greater medical costs here as well. They underpriced their plans across the board. If costs came in as they anticipated and the margins were similar to where they've been in the past, this number, this operating earnings number, it would be greater by about $6.5 billion. That's the scale of the problem that we're talking about for this year. 15 to 16 billion in operating earnings down to, low nines. The problem is not going to be fixed by next quarter. It's not going to be fixed this year. They need to reprice these plans. So on the earnings call, I was listening to what they would say about this, and they said multiple times, we are focused intensely on margin recovery. They said specifically about Medicare, our pricing strategy for 2026 assumes a cost trend of 10%. Keep in mind that last year they assumed a trend of 5%. The actual numbers are coming in at 7.5%. They need to make up that ground. They're assuming a cost trend of 10%. That sounds good to me. They said they likely won't be able to make up the full ground here in Medicare in 2026. Medicare margins in 2026 are going to be in the low range, aiming for further recovery in 2027. So while they also said multiple times, we are positioned for earnings growth in 2026, 2026 is going to be better. Repricing their book is going to be difficult here. 2026 is not going to be, as good as 2024, 2023. The recovery is going to take a couple years here. We see membership growing across the board, over 1 billion members added. I mean, again, the top line is not a big concern. In fact, they might be looking to slow growth in members added as they kind of fix the ship on the margin front. They're going to drop some of their PPO plans, they said. So they're very focused on margins here. Now, let's talk about Optum. I mean, we knew this was not going to be a great quarter, but Optum did not meet my expectations. I thought it would be a little more insulated from the pressure that is facing the health benefits side. Optum Insights, their software and analytics business, has incredibly high margins. Their PBM, Optum Rx, has historically had higher margins than the rest of the company, but they had a lot of headwind on Optum Health, and they cited accelerated medical trend and enrollment mix of complex patients, which sounds like fancy corporate speak for the costs were a lot higher than we thought they were going to be. They cited government funding cuts, and that's another uncertainty going forward. What's going to be the impact of the big, beautiful bill? There's going to be some cuts in Medicaid. Now, they are much less exposed to Medicaid than some of their peers. There also might be reductions in subsidies for Marketplace. So there's just overall a lot of uncertainty. And they did say this will improve meaningfully in 2026. Our business is getting better. And I think really the bottom line here comes down to what we believe about the future. Clearly, the top line is growing just fine. The demand across the board is there and only increasing into the future. The question is, do you think that the problem of margins is going to be one that they recover from? Are 2025 and 2026 the start of a new normal where margins across the board on all these companies are lower? Or did all of these companies just massively underestimate changes in costs and they're going to reprice their plans and margins are going to normalize back to close to the levels that they saw before? It's not necessarily an either or, it's more of a spectrum, and my thesis is more towards the latter. But that's definitely a contrarian opinion. The market does not really want to touch this right now. The market has this down currently about 4.5%, which honestly feels about right. It was, after all, a pretty bad report. They cut their guidance. But I think this shows us that a lot of the bad news really is priced into the stock down here. Guiding for just $16 in earnings per share is an absolutely massive miss. But so much bad news is already baked into this stock price, and the market is looking ahead. So let's go back to our sheet. Let's look ahead too. Let's see what we can expect for a return on our investment if we invest in UNH stock today. Now, the most recent quarter's numbers aren't reflected in my trailing 12 months here, but it's really not going to make any meaningful impact on our forecast. The real question that we have to answer is, where are margins going to end up? You can see my top line revenue growth ranges from 5 to 10% from my bear to my bull case. I think that's pretty conservative. Demand for healthcare remains strong. This isn't the question. The thing that's going to drive this model is operating margin. Historically, margins here have been, 7 to 9%. And my base case is assuming they just get back to the bottom end of that range. They just get back to 7%. Now, they won't do this by 2025 or 2026, but these numbers are not affecting the final return here. What's driving my model is the long-term operating margin and also the free cash flow that they can generate in the meantime. And you see that I'm assuming that free cash flow takes a massive cut for the next couple years, and I'm only giving them a 12 times multiple 5 years out. For the market leader and one of the best managed healthcare companies in the country, I don't think these assumptions are too crazy, and if this comes true, you're looking at an 18% annualized return on your money today over the next 5 years. That's more than a double. I think this is a pretty good return. My bear case is assuming just 5% operating margins, so effectively, they don't recover from this. This assumes cost headwinds persist. You also are going to have a big headwind from the big beautiful bill. You're going to have cuts to government subsidies across the board, and UNH is not going to be the same. We are seeing a new normal. I'm also giving them no free cash flow for the entire year and just an 8 times multiple 5 years from now. I think this is just about an absolute worst case scenario, and I'm looking at a negative 3% annualized return from here. So if these assumptions come true, after 5 years, you would be down, maybe 15-ish% on your position. That obviously would be extremely disappointing, but in an absolutely worst case scenario, I don't think it's that bad. And as for my bull case just assumes the company recovers to what it was before 2025. It's not baking in any more success than that. Top line growth of 10% is, basically what we've seen from this company. And in fact, they're doing roughly 10% growth on the top line this year. Operating margins of 8.5%. This is basically just assuming they reprice their plans, they get back to the margins they were before. I'm still cutting their free cash flow for a couple years, and I'm only giving them a 16 times multiple. This is the bull case, but I don't think it's anything out of this world. And if this does come true, if UNH recovers, you're looking at a 33% annualized return on your investment for 5 years. This is more than a 4x on your money. So in conclusion, there is a wide range of possibilities here. I don't have a crystal ball. I don't know the future. I just think the risk reward looks pretty good from here. It looks pretty asymmetric. The upside is quite large, and I think the ugly bear case is acceptable. And if you're watching this video at a later time and the price of UNH is significantly different, then you can see what my base case implies for returns based on price here. If UNH drops to the low 200s or under 200s, I am going to be buying heavily. And if the price goes back above $400, I'd probably have to relook at my model, look at my assumptions, see if I want to update anything. But just today, if I snap my fingers right now and the price were over $400, I don't think I'd be buying. So that's all I got for you today. If you got value out of the video, subscribe to the channel. If you want to buy me a coffee, I have a link down in the description. Absolutely nothing is expected. And if you agree or disagree with anything I said here, let me know that too down in the comments below. If you own UNH, what are you doing with your position? For me, I'm just sitting and holding here. I'm happy with the position I have. And I hope to see you all in another video.